As Richard mentioned, I look after the research for Colliers in the Central and Eastern European region, CEE. The countries I'm going to concentrate on today are the Visegrad 4 countries of Poland, Czech Republic, Slovakia, Hungary, plus Romania and Bulgaria. So I will use the term CEE 6. I'm referring to those 6 countries. The scope of what we cover at Colliers is wider than that, but that's the main content of this presentation is actually those six countries. Looking at the investment volumes that we've seen into the CEE 6 countries in 2017, we are now at a total of 7.6 billion euros. You can see on the right-hand side of this chart. And today, we are publishing tomorrow morning, and the update for the third quarter of 2017. 2.2 billion euros went into the CEE 6 countries in the third quarter, adding to the 2.6 and 2.8 that we had in Q2 and Q1 this year. Now, we are, in our opinion, approaching and likely to match the cycle high of 12.2 billion that we saw in 2016. Now, the record level was 13 billion at the peak of the previous cycle in 2007. Obviously, global financial crisis and then further recessions in some CEE countries meant that volumes were much, much lower in the interim. So we are back towards the cyclical peak in the investment scene in Central and Eastern Europe. Can we defy EMEA? Now, what do I mean by this? The light blue line on this chart is the investment volumes that have gone into all of EMEA, so everything from the UK to South Africa, including all the CE markets. That volume peaked at over 300 billion euros in 2015. On the right-hand side scale, I've got exactly the figures I showed you on the previous chart, but just as a line this time with an estimate of roughly flat volumes for 2017 in terms of the forecast. But it looks like the EMEA flows are dipping into the end of 2017. If you look at this dark blue line relative to the light blue line, it follows it. It lags it. So the question is, can we defy in Central and Eastern Europe, defy the cycle for longer? Our answer to that question is probably yes. But there are certain risk factors that I'll show you in this presentation, and maybe will also be discussed during the panel. Some of those risk factors may see the peak in the cycle come, but we believe that we've got at least a year or two of continued very strong flows into the Central and Eastern European region, and for the moment, it is different this time. The manifestation of those strong flows that I've just showed you is that some of the yields in the commercial property markets, particularly in Prague and Warsaw, have reached the same levels that we had in 2007. So these are the office, industrial and traditional shopping centre retail yields current and present in the capital cities of the CEE 6 countries. As mentioned, Prague and Warsaw are at those levels that we saw in 2007. Other countries, we still have higher yields, and obviously out in Sofia in Bulgaria, the yields are much higher. You see a spread of yields going upwards. But what's happening is, particularly in Hungary over the last 9 months, the yield change has continued. The yield compression has continued in Hungary. The office yields have fallen 50 basis points to 6%. Industrial yields have fallen 50 basis points to 7.75%. So further compression, further activity, further liquidity in the Hungarian market is pushing these yields down. Prices are rising. Similar sort of thing in Bratislava, certainly in the industrial arena. Actually, in retail, the yields have ticked up a bit. But in Bulgaria, on the right-hand side, also significant reduction in yields, especially in industrial, dropping from 11% to 10%. So that market is actually liquefying. We're actually seeing trades in the industrial sphere in Bulgaria. So it's interesting that these high yield markets are now being, let's say, chased. That some of this volume that we're seeing going into the Central and Eastern European markets is going into these high yield countries at this stage. got here the country and sector breakdown of the year-to-date 2017 flows into the Central and Eastern European region. Now, what's interesting for those of you who have followed the region for several years is that the Czech Republic's volumes are still larger than Poland. Poland's got 4 times the number of people that the Czech Republic has almost in terms of population, and usually has much larger flows than the Czech Republic. But Czech has still got a lead. This was established in the first quarter. Poland's been trying to catch up ever since, but hasn't done so yet. And so we'll see by the end of the year who will end up with the biggest volumes in 2017. The pipeline looks strong in Poland, so my money's on Poland for 2017 still. Hungary, strong and solid flows. The fastest grower this year is actually Bulgaria. 408 million, small absolute number, but that's a very significant 158% growth on the same period in 2016. Now, looking at the sectors, what's interesting with the sectors is the appearance of the hotel sector in Central and Eastern Europe. When this happens, it's often a sign that the economic cycle is strong. GDP growth is strong when hotel investment starts to flower and appear. 701 million so far this year. If one looks at a pure sector breakdown in the whole region, it's really retail that's driving retail flows that's really driving the Central and Eastern European investment. And this is across the board. All of the countries are seeing strong retail flows. The industrial sector tends to be a lot more lumpy, tends to be a lot more portfolio-driven, portfolios of buildings, particularly in the logistics sphere. And some of those deals are in the pipeline, some large deals are actually in the pipeline, but haven't manifested yet. So the industrial sector has not grown that fast compared with 2016. Now, in terms of origins, where's the money coming from? We noted in research that we published in March, actually entitled The Changing of the Guard, and that's available on our research website, is that what we've seen since 2016 is that the traditional sources, Western Europe, UK, USA, which here in the first 9 months of 2017 made up for around 42% of the total pie, used to be in 2011, if I presented you the pie for 2011, it would be almost 100% of the flow into the Central and Eastern European region. What we had in 2016 was, as I termed it, a changing of the guard. That new sources of capital came into being relevant, and these were Asia. So here, only 5% in the first 9 months of 2017 coming from Asia. So lumpy flows, but Asian money tends to be very large, given the population base, the economic base of all of the Asian economies. When they come in size. And there's portfolio deals that are likely to be finalised even in the fourth quarter of this year coming from Asia. South Africa. Now, South Africa has made a comeback in the third quarter of 2017. If you look at the right-hand side, 25%, a quarter of the flows in the last quarter, about 2.2 billion came from South Africa. In 2016, they were 20% of all of the flow in the region in 2016. So taking into account that 25%, 14% year to date, making a comeback. But the other element of this changing the guard is actually domestic flow. So 23% of the flow year to date in the region is domestic money investing domestically in CEE. So in each of the CEE 6 countries, adding up the Czech flows in Czech, adding Bulgarian flows in Bulgaria, etc. Another 11% is CEE cross-border. So this is money flowing from one CEE country to another. If we add them up, 34%, a third, 1 in 3, 34%, 1 in 3 euros going into CEE is coming from within the region. This is what I mean by the changing of the guard. I can tell you, within this, 20% of all the money that's going into the region is coming from the Czech Republic, from that one country. It's bigger than any other country so far in 2017. 20%, either Czech money into Czech or Czech money into the other countries. 20%, 1 in 5 euros being invested in the region is coming from the Czech Republic. Now why? What's happening? Well, very strong growth. These are the GDP growth numbers for the first quarter in light blue and the second quarter of 2017 on a year-on-year basis for the CEE 6 economies. The slowest grower is Hungary at 3.2%. I mean, there's quite a few European countries that would love 3.2% economic growth. Romania is perhaps overheating, 5.9% economic GDP growth. And the rest are in a range in between. So we have a very strong underlying growth story. This means very good news for tenants, very good news for the demand side for commercial real estate. It drives the demand in the retail sector, it drives demand in the manufacturing sector, it drives demand in the logistics sector directly, and indirectly in the office sector as well. GDP growth is a measure of economic well-being. It's also manifest in that some of that GDP growth that we're seeing is going into infrastructure investment. A lot of that Czech Republic 4.7% growth in the second quarter was due to investment in new factories, investment in new industries, and some of it is going into building up the infrastructure of the region. Now this is key. Think of the geography of these countries. They are connected to Europe, but they're not particularly well connected. Now, with the help of EU money, with the help of good fiscal balances across the CEE 6 countries, we are seeing the growth in motorway, in highway kilometres. In 2015, these are Eurostat figures, 2015, 1,600 kilometres of highways in Poland. What's interesting is that over the previous 9 years, almost more than half of that was built in the last 9 years, so very modern, very new. Now, this makes a difference to how these economies work. If you look at these two bars in Poland and Hungary, they're greater than the investment made in the UK, than Germany and France, any of them. So the CEE is connecting itself to itself and also westward. So the impact that this has on economic growth in the medium to long term is well founded. You can take any country, any emerging market in the world, you can look at these sort of statistics. This generates economic growth. This generates demand for real estate and therefore the hope for supply as well. 5-year growth, only the Czech Republic and Slovakia have less growth of highway kilometres than those big Western European countries. The others are all still building their roads. I can tell you Poland and Romania in particular are continuing their road building programs. So this momentum should well continue. A manifestation also of economic growth is that it does have a positive effect on tenant demand. And here what I've tried to do is, I've got the plot here as an example of the prime Prague office sector rental level versus Czech GDP growth. So Czech GDP growth is in the light blue. Now, if we ignore the global financial crisis, let's just say that this was a big bounce, which it was. The Czech cycle actually peaked in 2006, 2007, and bottomed out in 2012, 2013. So it's a good 7-year cycle. And you can see what I've done on this chart is, or had the rents, I've pulled them back in time. And you can see a match with the rental levels, if we ignore the global financial crisis. So this suggests that rental levels, if all other things stay equal, rental levels in the prime Prague office sector should rise over the next couple of years due to the very strong GDP growth that I mentioned for the Czech Republic. So this is a positive story if you're holding office assets in Prague, in the Czech Republic. The demand seems to be underpinned. Now we might see more supply, and that might be a discussion on the panel, during the panel. Will we see more supply? Perhaps, but this is an indication here of how demand, GDP growth can drive demand in the real estate arena. Now, what's the key risk? The key risk, really, to this story is that it's too good. That economic growth that I showed you 2 slides ago should cause inflation. At the moment, we have quite low levels of CPI inflation. The dark blue bars on this chart are the CPI, the latest year-on-year growth rates of consumer price inflation in these economies. The highest is Czech at 2.7%. I live there, I see it. Inflation is rising in the Czech Republic. Lowest there is at Slovakia at 1.6%, so in that range, 1.6 to 2.7%. We've got varying interpretations of this in the bond markets. The light blue bars on this chart are the 10-year sovereign bond yield. So everyone follows on the right-hand side the US Treasury yield 2.39% last night. In Romania, we've got a proper premium of yields over inflation. So yes, inflation is rising in Romania, we might see those yields go up a bit. But in some countries, such as Czech Republic, the inflation is much higher than the yield. Now this yield is going up. It has gone up in the last few months and it will continue to go up. Why am I showing you this? Because obviously most real estate investors employ debt. A lot of the banks, as you'll be able to ask on the panel, look at the sovereign bond yield as a major driver of their funding rates and the amount of money they're prepared to lend to real estate investors to buy property. So this is directly relevant. If these light blue bars are going to rise over the next year, this is a risk for the CEE real estate sector. As I said, Czech has gone up recently, Romania's gone up recently, Hungary's actually gone down. This 2.59, it was above 3% 9 months ago. So there's a sort of varying reaction going on. Obviously there's a bit of chaos in, I would say, in the European bond markets with the quantitative easing policy that the ECB has been following and the pricing of credit risk in Europe, which in my personal opinion is a bit mad. But we will see how this ends up. But if inflation keeps rising, these bond yields will rise, funding rates will go up for real estate investors. Now, another manifestation of the rising inflation is that one of the reasons it's rising is the wage growth. Now, the light blue bars on this chart are the percentage wage growth estimates for the whole economy that we have for 2017 at Colliers. At Colliers, Hungary, 13% growth in wages. You should be in Budapest working, get 13% pay rise on average in 2017. The point on this chart is really that this 13% is vastly higher than the CPI level. So this is money in people's pockets. This is real money. They're spending, the cost of what they're having to buy in the shops is going up by 2.5%. Their wages are going up by 13%. This is money in the pockets, as I mentioned. And this is inflationary. Now, it's very positive for the demand side for retail and for logistics, but it's much less positive if you're a manufacturer trying to keep your wage costs down, and if you're a BPO SSE, shared service operator, which is very big in the office sector in Central and Eastern Europe, trying to hold your wage costs down, this is a real problem if you've got some of these figures that I'm showing you here going on. In the auto sector, we just produced a study on the CEE auto sector, and the labour force price was seen as the most relevant factor for locating in Bulgaria in 2016. This is a situation, talking to my colleagues in corporate solutions across the CEE region, that the labour force price, the labour force accessibility is a very important factor at this point. And as mentioned, those wage costs are going up. So this is maybe a problem for this auto sector. The auto sector is very important in Central and Eastern Europe. It makes up between 15% and 35% of the exports of these CEE countries. Massive. So there's a bit of an issue here. But fortunately, at this stage, the unit labour costs, so the wages per hour across the industrial sector in the EU 28 to 26 euros per hour. In Slovakia and Czech, the highest in the region, it's 10, 11. So we're still much cheaper. We can have a doubling of wages in the Czech Republic and still we're cheaper than the EU 28 average. But obviously, if you move too quickly on wages, you become uncompetitive very quickly. So we've got to watch this very closely. This is why I've been talking about it a lot in my research in 2017, because I believe that it does affect the investment demand for real estate in Central and Eastern Europe. Published another piece suggesting that one of the solutions to what I've just told you, the problem I've just outlined, that wages are rising very fast in the region, is that we may see a return of people who hold the passports of these CEE 6 countries back from Western Europe. I call this the labour force boomerang. 1 in 7 Romanians, 14% of the population, live outside Romania. They live in Western Europe. Quite an extraordinary number. 10% of Bulgarians, 6% of Poles, of which 2.2% are sitting in the UK now. Yeah? 2.2% of Polish passport holders live in the UK. So these are massive numbers. Imagine if these people had not immigrated, what the Central and Eastern European economies would look like. We're dealing here with mostly productive people, workers, very educated people in many cases. Why might they go back home? I've turned it to personal P&L. If we've got that faster wage growth, if we've got a cost of living that's rising faster in some Western European countries. For example, here in the UK with our retail price inflation of 4%. If we've got a currency situation, for example, the Czech crown going up versus the euro and the pound, and therefore if the migrant is thinking in local currency terms, they may think, ooh, if the British pound is going down, this is a problem. I'm losing purchasing power in my own currency. If they have lower taxes, which they do in Central and Eastern Europe, income tax in Bulgaria is around 10%, in Hungary it's been cut to 9%. This is very attractive for people thinking merely in financial terms. Then on top of that, obviously there's a quality of life argument. Are there too many people in Western Europe? Is there too much competition for jobs? Is there a language issue? Is there a status issue by being a migrant in the country? Are there environmental issues? Are these things improving in Central and Eastern Europe relative to Western Europe? All these factors, I believe, will lead to some boomerang occurring. I'm not saying all of these people will go back home, but some of them will, I think, over the next 2-3 years. Final slide I wanted to show you in terms of a theme is the residential markets. So in the reaction to that strong wage growth I mentioned, in reaction to the strong economic growth that I mentioned, these are the year-on-year changes in house prices in Central and East, across the EU. Central and Eastern European countries are in the dark blue. The average in the EU is 4.4%, UK at 5%, Czech Republic 13.3% year-on-year growth in house prices. This is why the Czechs need to raise interest rates. If you don't raise interest rates in the Czech Republic is presently 0.25%. If you don't raise interest rates, this will go on and on and on. We saw this in the UK for a long time. This is economics. So something needs to happen in terms of interest rates, but still in the other countries have also got very strong house price growth. So the immediate prospects for the housing markets in these countries is very good. And we're likely to see, obviously, some supply reaction to this, which is good news for residential developers. We're not seeing how much investment into this sector as yet, but it may be something for the future. So just to summarise, strong momentum in the consumption-led GDP growth is a big theme. This helps the retail sector, certainly it helps the logistics sector. The wage growth within that is also helping the retail sector because people have more money in their pockets. We're seeing a spike in inflation in Europe. Now this is important, within the CEE 6 countries, that almost all the commercial rents are benchmarked to Eurozone CPI, European CPI. So a CPI in the Eurozone of 1.5 to 2% is actually adding to rents. So it's good news in the short run. Are we going to see a development boom in CEE? Quite plausible, I believe, in the next 18 months as a reaction to what I've just discussed, and also a relative lack of supply, which is something we may discuss in the panel. And also, I think that the effect of any rate rises is not immediate because we've got this big cushion. For example, in the Czech Republic, those bond yields are at 1.6, 1.7%, real estate yields at 5%. There's a big gap between those two numbers. So there's a cushion. But obviously, if interest rates rise, the yield will the real estate yield will probably not fall too far from here. So that's what I mean here is a positive, that the effect may take some time, but the main negative is the rates rising over the next 12 months. We've obviously got the e-commerce risk that I've not really mentioned. E-commerce penetration is lower in CEE than in Western Europe, but it's there, and it's growing fast. Wage growth is negative for BPO and SSE in office and industrial. And then maybe some political factors. EU funding. In Central and Eastern Europe, we do have more populist type of governments. We just had some elections in the Czech Republic on that, which is fresh news on that front. Will we see some disruption in terms of the EU relationship with CEE, possibly? Taxation risk. I call this the Trump Brexit kind of phenomenon, that we may see more taxation of capital rather than taxation of labour. That's a conceptual issue. And then emerging market risks at the bottom, China, debt instability, or what Mr. Trump might say, or President Trump might say or do, US policy uncertainty might spike the very strong developed market sentiment that we're seeing in asset markets presently. And that can send all emerging market asset prices down.